Welcome to the Ken McElroy Show. I'm your host, Danille, here with Ken.
Hey guys, what's going on?
And just so you guys know, we are pre-recording this episode because this weekend is Ken's birthday.
That's right. Yeah. So happy birthday to me.
Yep, it's Labor Day weekend. So we're going to be having friends in town in Manhattan Beach, celebrating Ken. And on Monday, we're probably, cooking out on the beach or something.
Yeah. And I didn't want to do a show after I had a cocktail.
Exactly. Although that would be pretty funny, perhaps.
Yeah, maybe one day.
So today we're going to be talking about a business plan and what you should look for if you're putting together a business plan and what you should look for if you are reading a business plan. So very, very good information.
Yeah. So as you guys know, so I get this question a lot. So we have a lot of investors that invest with us, obviously. And then we actually are always trying to raise capital. So depends on which side of the fence you're on. If you're on the I'm trying to raise capital fence, then of course, there are certain things that need to be in the business plan. If you're an investor, then you're going to want to see certain things in there, and you're going to have a series of different questions.
So where should somebody start? So let's start with the people that are writing the business plan. So where should they start when they are beginning to put together a business plan?
Well, the best thing you can do, obviously, is there's Garrett Sutton has a great book on how to write business plans, and I contributed to that book. So that's a great place to start. But also, just go get business plans. Get 8 or 10 of them. And it doesn't matter if they're real estate based. It could be for raising money for a pizza place. It doesn't really matter. Just a business plan, anything that is used to raise capital. And you'd be very surprised. You might see a 1-pager and you might see a 100-pager. So the business plans are not all created equal, and different people do different things in business plans. And so I think that's the first place to start.
When you personally, when you get a business plan, you like the smaller, more concise ones with less fluff.
Well, right. So what I always say, and it's not always the case, but generally I think it probably is. For some reason, people think that a lot of data and a lot of stuff, are good in a business plan. I'm always looking for ways to cut out all the fluff. I want to say it concisely, and I don't need a whole bunch of collateral material. And sometimes people want that later, so we might provide it. But I think what happens a lot of times when I see business plans is people take studies and, from consultants and cities and data on a market or whatever, and they jam it all into this stuff. And then the financial piece is, this big. And, so they're light on the actual, how am I going to make money? And heavy on, the sales part, this is why, so they kind of lead with that. And I understand that, and sometimes there's a need for that, but most of the time investors. Well, so I'll tell you, back in the day when some of my business plans maybe had a little bit more of that, you sit down with an investor and they flip right to the back and go straight to the number.
Right, because a smart investor, that's what they're looking at.
Yeah, they're investing in you. They're investing in your team. They're obviously investing in the project. They're wondering whether or not you can pull it off. And if you're going to take their money, how are they going to get it back?
Exactly. So maybe we skipped a step. Why is it crucial to even have a business plan if you're trying to raise money?
That's a good point. So probably should have started there. I think it memorializes what you're going to do and what you're promising. So I love these because it's where the rubber hits the road. It's a document that's a non-legal document, but nonetheless, it's a document that says this is what your plan is. So I've had investors 2-3 years down the road pull out their business plans, and I get on the phone, I pull out my business plan, and we talk about it. Mm-hmm. Did we hit the number? Where are we? So it's kind of a guide, I guess, and you need that, especially if you're raising capital from people.
So correct. And they need to know, that you're serious. If you just go up and you say, hey, I need some money, not very many people, unless it's family or something, is just going to give you money. So you're going to need some kind of plan for what to do with it.
So you guys need to know, even, I've obviously done hundreds of deals at this point. And when I call up, somebody like, let's say Robert or Kim Kiyosaki, who I talk to almost every day, and I say, hey, I got a deal. And they just say, I'm in, and there's there's a lot of investors that do that at this point. I've earned that. But even then, I still am making sure that I give them a business plan and show them what the returns are and show them what the numbers are before I take their money. And so it's just really, really important, because if it's verbal or maybe through emails or kind of loose or vague, then that's when things can go wrong.
Yeah, they might have a different expectation. But you keep mentioning, the financials. So can you explain to those that don't know what is in the financials that needs to be in your business plan?
Well, first of all, you need to know what the ask is. So let's say you need $1 million for something. It doesn't really matter what. That needs to be right up front. We're asking for $1 million. Our goal is to pay it back in 36 months or 48 months. And here's how, and then you need to go into what it is you're buying, what it is you're doing, how that's going to work. And you need to kind of walk through that year 1, year 2, year 3. And so that's what we do. We have year 1, year 2, year 3, year 4, year 5 in our business plans. It shows what we think that, let's say you raise that $1 million. Let's say you get $100,000 from 10 people. That you need to actually show them what you think you're going to be able to return on that $100,000 in year 1 and year 2 and year 3. And so you have to have a plan for their money. You have to show how it's invested. So I was and I'll tell you an interesting thing that happened to me once. Somebody came to me and said, I want to do this business. And I said, okay, I'm listening. And by the way, very prominent. And I'm like, I said, well, how much do you need? He's like, I'm raising X. And I said, okay, so I might be able to give you like 250 grand. If I give you 250 grand, what are you going to use it for? And he goes, salary. I'm like, so, I mean, it's a true story. So, like, you got to be careful of what they're using the money for. So if they're using the money to pay for a bunch of people for a period of time while they're trying to grow a company, then that's probably not prudent. But if they're using the money to buy something, invest in something, and they're deferring and they're kind of behind the 8 ball too, that's different. So you got to be careful on what people are asking money for.
Well, but that's more on the other side. That's more on the, investor side versus the person trying to raise money.
Yeah. But I guess the point I want to make is if you're doing a business plan and your idea is to raise money for a bunch of payroll or salaries, you're probably not going to raise the money, which is exactly what happened.
Exactly. So, and then something else, you need to put in your business plan, like your growth strategy, right? Like how you're going to make money on the money.
Yeah. Like think about it. Like if you gave somebody some money, you would want to know when you're going to get it back, how much money that money's going to make and how. And so for us, what we show, like in the apartment buildings that we buy, we're buying it for X. And here's what we think we're going to do in growing the net operating income. And so we grow the net operating income, which grows the value. And then we say, and here's how we get your cash back. Once we've grown the net operating income, we go back to the bank. We do a cash out refi. We do a distribution back to the original equity. And so it's all very transparent. And that's our plan in the beginning. And so all that stuff has to be thought through.
But you never make promises on the return because real estate's very fluid, right?
No. The business plan is, there's no way you're going to hit it perfectly. I mean, it just isn't going to happen, but you have to think it through. So it is a guide. It is a goal. And obviously, the team thinks that they're going to do it. but it could be close, it could be under, it could be over. We've had properties where we've blown right through our projections, and they've been way, way, way better. And we've had some that have been flat. So it's you sit down and you need to walk through it, and that's how you raise capital.
Yeah, definitely. So let's flip the coin on the other side now. So you have these investors that are looking to invest with someone, and they want to know how to read a business plan. And, MC is actually putting together a business plan right now for a new deal
for
you're
a
doing,
deal
right?
in Austin,
Yeah. And so what do you recommend when they're reading through these business plans, to look out for?
Yeah. So this is based on, right now we have 2,500 investors that potentially could get this business plan. So this is based on sending a business plan out to a bunch of high net worth accredited people that are looking at it and asking questions. So this is when I get on the phone with them and we start talking about that deal. So the business plans that we send out are getting more and more and more refined based on questions from the investors and things that they want to see. And typically, the investors want to know a lot about the team. How is the team going to pull it off? Because if you're a team of one, it's going to be hard. And by the way, there are business plans that do that. Now, I'm not saying that you can't have all that stuff outsourced, but they want to see what's the term sheet on from the bank, and you might want to have the term sheet in there. So let's say on the debt side, you want to actually have all the details of the term sheet. They're going to want to know who's going to manage the project, who's going to be running the project, and what's the accountability of all that. They're going to want to know a little bit about your track record, if you have one. If you don't have one, you can partner with somebody that does have one. It's going to raise that level of credibility. That you want to show that you're bringing kind of a level of expertise to it. Because if somebody gives you money, they're not going to want to give it to you while you're cutting your teeth on a new business, right?
Yeah, definitely. And you also have to be careful. I remember when sometimes they raise money and you give money up front, but then they didn't raise enough money, so they lose the hard money. Can you explain that?
Yeah. I've seen that happen before, where what that means is, let's say, like right now, if we're trying to buy real estate, we're having to put non-refundable money in escrow today. And then we still have to go out and get the debt and equity. If we don't perform, let's say, and we can't get a loan, or we can't get the equity and we can't close, that money's gone. So Ross and I just put $2 million up on this Austin property. And so if we don't perform, that's $2 million gone. And so what happens sometimes people raise that money. And I've been a seller in this situation where we had investors actually call us that were from the buyer, and they said, hey, we gave this, we wired some money in, or gave some money, and we lost it in a deposit because they couldn't actually close on the deal.
Right. What happens is they raised enough money for the deposit, and then in hopes that they were going to raise enough money, for the rest of the down payment,
and they
fell short. And so since that is the hard money was given up front, then those investors are just out their money.
Yeah, exactly. And so in our case, it's Ross's and my money. So we put the money up. We don't raise the money from investors. We don't raise deposits for investors. But
a lot of people do.
A lot of people do, yeah.
And so that is something to think about. And something else, too, is when people are reading the business plan, and I know you've done this before, you have to see, the numbers, are they realistic? Like, are they accounting for vacancy? Are they accounting for capital expenditures? Because a lot of times they show you the business plan with all the units rented at the top rent all the time.
Everybody's selling. So you just got to know that. So the seller's selling, the broker's selling, and the person trying to raise capital is selling generally. So you have to weed through all that crap. And, so for us, part of due diligence, or part of understanding what the property's worth, is pushing back against the seller, pushing back against the selling broker, and understanding on the reality of what you're stepping into. So what happens is, typically, like, we were looking at a deal this last week in Dallas, and the seller or the broker said, our bottom line number is 105 a door, which is actually a pretty good number. So our acquisition guy took a look at it, and he said, you can make us an offer for less, but at 105 a door, we're just going to counter back at 105 a door. So once we got the information, we realized that the property was actually negative $300,000 a year. So income minus expenses minus debt, they were actually feeding it $300,000 a year. So on day one, we would have stepped into an asset that was negative $300,000 a year. Now, could we correct it? Of course. Was there high vacancy? Of course. Was there deferred maintenance? Of course. So all that stuff has to be factored in. But the truth is, that's why I say be careful not to catch a falling knife. This was a deal where the guy was negative. And 105 was probably his break even. He was just trying to get his original capital back. But what he had done is he had raised a bunch of money, poured it into the property, who knows exactly where. And he was running it probably himself horribly. It had like 26% vacancy. And so what happens is the broker is going to show it at 5 or 6% vacancy because maybe that's what the market is. They're not going to show it at what the actual operations are today. So all that has to be figured. That thing would take a year to turn around. So that's another $300,000, let's say, if it even could be.
If they know what they're doing too, right? If they know what they're doing. And, to be clear, MC Companies has a whole team looking at this, So whoever you're investing with, you really, like what Ken was saying, to look at their team, you really have to look and make sure they know what they're doing and they have the right team in place to catch all of these things.
Well, that's kind of the whole point. Like, you need to know what you're buying on day one. Because day one, you're stepping into the shoes of somebody else, period. So, in every way, like every vacancy, every occupancy, every tenant, every expense, it's like a handoff in a relay. You're essentially getting whatever the seller had, you're getting. And so you just have to be super clear on that day that you know what that is. And so that's kind of the gray area, and that's the piece that should show up in the operating financials. So that's actually the battle always internally between our property management folks and the seller is, the seller always is going to report, and the broker's always going to report what the market could be and should be, and very rarely on what it is. So that's kind of always that always needs to be flushed out, and that needs to be in the business plan. Because if you're raising new capital and you're going to step into somebody's shoes right then, and you need to account for that.
Yeah, you need to be an educated investor. You never just want to give anyone your money and just not hope for the best,
Yeah, and I'll tell you a funny story. So Ross and I decided to sell a couple properties like 2 years ago. And we were the seller, and we had gone to the management company first and said, hey, what do you guys think of this? Is there any way to move the needle and create more value in this asset? And internally, the answer was no. So we decided to sell it. Said, okay, well, we don't think this market's going to go up anymore. We don't think this rent's going to go up anymore. Let's sell. So we got it into escrow, and we had a buyer. So the broker listed it, and we had all these bids and all that. We got into escrow with a buyer. Lo and behold, the buyer sent me their business plan. So I got a business plan on a property that I owned.
Right. Saying how bad it was run.
To invest in. Yeah. So you imagine I'm the seller and I'm being pitched as the buyer. So that was cool because now you're taking a look at the business plan. So I knew what the numbers were. I knew obviously the property, and the syndicator or the buyer, was saying, oh, the rents are under market, the expenses are too high, the management needs to be changed, the ownership hasn't been spending money on the property, of course, which is us. And, so you can pretty much put whatever narrative you want in anything at any time to make it look whatever the optics are, whatever you want them to be.
Yeah.
But the truth is it only can be what it is. So the rent rolls, the operating expenses are, those are fixed black and white numbers. And so is the occupancy and everything else. And it's true, maybe there is upside and maybe there is, room. But we had already looked at that as a company. Maybe they were seeing something that we hadn't seen. But the point is the optics are whatever the optics are. So, people take something and they make it be what they want it to be. Your job as an investor is to dig in on those things.
Yeah. And then the last thing I would want to bring up is, you want to invest with somebody that's experienced. You don't want to be going into somebody's first deal. I mean, if it's a small deal, it's like a single family, that's a little bit different. But if you're doing some kind of multifamily kind of deal, you want somebody that really understands what they're doing if you're going to be giving them your money.
Yeah, this is now, again, there are tons of deals that can be good if they're super easy to understand, but there's a lot of moving parts like a big project, and they don't have a nice big track record with, a team. Then there's the chances are there's a lot more that's going to go wrong.
All right, guys. So that is all about reading a business plan, but we're going to jump over to our premium questions. We have a great premium group on Facebook. If you guys want to join, it's $19.99 a month, and you get full access to Ask Ken questions.
Yep.
So Missy's question is, what do you think the update is for commercial buildings? I understand that commercial is a high-risk venture at this time, but I'd like to hear Ken's take.
So commercial is a category. It's not a building. So, commercial can be multifamily, it can be office, it can be industrial, it can be retail, it can be mall. So that's actually what's considered commercial. And it can be other things, of course. But I think every one of those is very, very, very different. So if I was to rank which ones I think would be the toughest moving forward, it would probably be commercial office. Because of obviously that's happening with the work from home and the pandemic and all of that. The next one would be retail, with everybody's kind of moving into, but basically buying online, and people are basically not getting into their cars as much and going down and buying things at places. And so you're starting to see kind of the small landlord go out of business, and the pandemic obviously didn't make that any better. And so you're going to start to see that show up, and all those people pay rent to a landlord, just like on a commercial building. And so as these commercial buildings, their leases start to expire, I think they're going to start to downsize their footprint on exactly what they need from a corporate office standpoint. So those are the ones that I think are going to be probably the biggest hit. Malls are an obvious big black eye.
Those are rough.
Malls, yeah. I mean, you guys know. So people are now looking at malls for distribution centers, for corporate offices, redevelopment, and so those three are kind of in jeopardy, and those are all considered commercial. On the positive side of commercial is multifamily and industrial. So, think of last mile, think of Amazon, think of big warehouse and distribution. So as people want things now, they want things, they order something at 10 and they want it by 3 or 4 or 5 that day, that's all not going to come from the middle of the country, so these regional distribution centers are all over. They call it last mile. So that last mile, and those are doing very, very well. Multifamilies on a nice little run here. I think it's going to continue to go on a run because, especially with the eviction moratorium ending and and the forbearance, we're going to have some movement from single family into rentals, and we don't have enough rentals to deal with the demand.
So Nikolai's question from Premium, so he's clearly a new investor raising money for the first time. So he said on a single family rental that's $100,000, let's say they put up 50% of what he needs. What should he promise them in return? So I'm assuming he's having one investor that's giving him half the money. So he wants to know what he should give him.
So good question. So I think that in that scenario, obviously you got to think that you're also going to have 50% in debt. So you got to be thinking that is an expense. So let's say you're going to have a debt payment. And then also on the 50%, you're also going to have an equity payment. So the equity is not free. It's no different than debt. It's just priced differently. And so typically what you might do is if there's some kind of way to increase the value, then what you might want to do is do it based on some kind of future performance or some kind of future exit. So think about, let's say you can grow the value to 150, or now you're looking at basically a $50,000 profit. So how can that be split up? And maybe it's 50-50, maybe it's 60-40, 90-10. There's a bunch of ways you can split that up. The other thing to consider is your monthly cash flow. So if you get 50 grand from somebody, what does that return from a cash flow standpoint? But my guess is that an investor is not going to let you scoop all the cash flow for yourself. They're going to want obviously a payment on their 50 grand while all of that is happening. So it kind of all goes back to cash flow and what you're actually trying to do with the real estate itself.
Yeah, and so what would you recommend though? I mean, you kind of answered that like a politician.
Okay, well, I'll pick a horse. So if I can grow if I could grow it by to 150 and sell it in 3 years, I'm going to make those assumptions because I clearly don't have them. Then I would do like a 75-25 deal. I would give the investor all the cash flow. I would pay him 75% of the net proceeds, and I would scoop 25.
Okay. So what you're basically saying is somebody is giving you a big chunk of the money, you feel like they deserve a big chunk of the equity.
Well, what are you doing for zero?
That's a good point. So anyways, we're gonna wrap it up there. Thank you guys. And we'll see you next Monday and tell you all about Ken's birthday party.
All right. See you guys.